High-frequency trading.
High-frequency trading, HFT, is a type of trading that uses advanced computer algorithms to execute large numbers of trades at incredibly high speeds. HFT firms use complex mathematical models and algorithms to analyze market data and identify patterns and trends in real time. These algorithms can then automatically execute trades in fractions of a second, based on the data analysis. HFT firms typically use specialized computer hardware and software to enable these trades to be executed at extremely high speeds. They may also use techniques such as collocation, which involves placing their computer servers as close as possible to the stock exchange's servers to reduce the time it takes for trade orders to be processed. The goal of HFT is to profit from small, short-term price movements in stocks, currencies, or other financial instruments. HFT firms may engage in various strategies, such as market making, arbitrage, or statistical arbitrage, to take advantage of these movements. While HFT can potentially generate significant profits for traders, it has also been associated with increased market volatility and the potential for flash crashes in which stock prices can plummet in a matter of seconds.